السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
Have you seen people making multi-bagger returns within a matter of a few weeks when a company goes public for the first time? You may have followed the controversy where BharatPe director and Shark Tank jury Ashneer Grover was locked in a legal tussle with Kotak Mahindra Bank over failing to provide financial assistance despite the assurance and allocation of shares in the beauty startup Nykaa, whose price range was between 1,085 and 1,125, but on listing, the prices rallied over 2,200 mark, which is over 100% return in a matter of weeks. No wonder why Ashneer got so annoyed. Anyways, the point that I want to make is that investing and trading in the market has their own merits. So does applying for the right IPOs. You can make insane amounts of money in a very short span of time. But to do that, you need to know how to select the right companies and the right IPOs to invest your money. And to do this, you need to be aware of the processes involved, the technical aspects, and the terms or jargons that are associated with the IPOs. In this video, we will do just that. I will guide you through the entire process and the selection of the right IPOs and a lot more in a step-by-step manner. So watch the video till the end, and a like in this video will be a motivation booster to make more such quality content. And if you are new to the channel, make sure to subscribe and enable the bell notification so that you won't miss out on any upcoming videos. To understand what an IPO is, we need to learn why in the first place a company goes to file for an IPO. Let's take the case of a private company ABC, which has been around for let's say 6 years. The company has progressed really well over these years. They have managed to successfully diversify their product portfolio, and they have a presence across all the major cities of the country. And most importantly, the debt is very low compared to revenues and profits. The revenue of the company is rising every quarter, the profitability remains stable, and the early investors are really happy about the company's performance. Now, let's say another company has emerged as an opponent, trying to penetrate their market share. So now the promoters of company ABC are really concerned with this new company, and one way to grow faster than them is by expanding rapidly, not only across the nation, but globally. So the promoter wants the brand to be available across all major international cities. This means the company need to invest more on real estate, manufacturing, and market research to understand the likes and dislikes of the people in other countries. But this is no easy task. It requires money, and a lot of it. Now, this expenditure to expand the overall business is called as capital expenditure. This could range from hundreds to thousands of crores. Now, where will the private company ABC get their capex fund from? So there are a few choices available for the company. The first and foremost option is to raise a series of funding from a private equity investor or a private equity fund. The second option is to raise debt from banks. The third option is to float some of the bonds. And the final option is to file for an IPO. Now, if you look at these options, raising capital from private investors or equities and venture capitalists might be an expensive affair. Also, raising money from banks in form of debt can be a headache if things don't go as planned. The same goes with floating the bonds, which is yet another form of debt. A company always tries to reduce their debt load so that they can use the money to grow their business without putting everything at stake. So the only alternative is to opt for an IPO or initial public offering. And as the name suggests, it is the first time the shares of a privately owned company are made available for the general public, high net individuals and institutional investors to purchase. Now, in this process, the company loses its autonomy and goes from being a private company to a public limited company. Now, other than gaining money, IPO has other advantages. So after an IPO, the early investors in the company can finally sell some or all of their shares or simply liquidate their stake in the company. Now, the company will also gain credibility and visibility after an IPO. So having their shares traded on a major exchange, it might boost the company's reputation and image with the general public. And on top of that, IPOs can also help to attract top talented people to work in the company. Also, with publicly traded shares, it is easier to offer stock compensation plans to the employees, which can make the company a more attractive place to work. Now, let's keep all that aside. To borrow money from the general public, the company must list itself on the stock exchange. exchange. So after an IPO, the company gets listed on the stock exchanges, and this procedure gives businesses the legal authority to borrow money from the general public. But the process behind the IPO is not so straightforward. Before we get into the entire process, we need to be aware of a few key jargons to be able to understand the sequence of IPO process entirely. The first and foremost are the price band and the cutoff price. See, whenever a company goes for an IPO, it sets a price range between which the shares can be bought by the public. This price range within which the investors can bid for the company's stock for the first time is called as the price band. Now, in the Nika example, the price band was between 1085 and 1125, where 1085 is the floor price and 1125 is the cap price. Now, the spread or the difference between them is 40 rupees. And according to the SEBI regulation, this spread between the floor of the price band and its cap should not be more than 20%. And the cutoff price is nothing but the offer price at which the shares get issued to the investors, which could be any price within the price band. Now, talking about the issue price and listing price, issue price is the price which you are likely to pay to purchase the IPO shares, and listing price is the opening price of the particular stock once it is listed in the stock market or the stock exchange. The third important term is the draft red herring prospectus or DRHP document. Now, the DRHP, also known as the offer document, includes all the data about the business, its promoters, projects, financial details, objective of raising money, etc. of the company filing for an IPO. So it contains all the relevant details of the company except for the price and the number of shares which are being offered. The DRHP document is made public and is utilized to invite subscriptions to the company's current offering. Now, the DRHP document that we have just talked about is prepared by a merchant banker. Not just this, the merchant banker for the IPO is also in charge of promoting the issue of the IPO and making sure that all regulatory requirements are met during the IPO process. Now, the company selects the merchant bankers. For example, the government of India appointed 10 merchant bankers for managing the giant LIC IPO. The bankers to issue are banks that facilitate the transfer of money throughout the issue process, and they clearly state the status of funds that are accessible to the registrars, enabling the registrars to confirm the basis of allocation, which is actually the process of allocating the shares to the shareholders based on the prior agreements. The registrars to the issue collects the application form from investors, keeps records of the application and the money received from the investors, and they are also involved in finalizing the basis of allotment in an issue, sending refunds, etc. The other important jargon you need to be aware of is book building, which is actually a price discovery method, and it helps in finding the intrinsic value of the shares which are being offered. Now, the price of the share is determined in a more realistic way by taking into consideration the demand for the security among investors before arriving at an issue price. Actually, companies like Paytm failed in this particular process, which led to an insanely high issue price, leading to its downfall on the listing day and the days to come. Yet another interesting term is undersubscription. So an IPO is said to be undersubscribed if the bids received are less than the number of the shares offered. So let's assume that the company ABC intends to offer 2 lakh shares to the general public. Now, if it is revealed during the book building process that only 1,50,000 bids were received, the issue is said to be undersubscribed. Now, this is not a good scenario for the company as it reflects unfavorable public opinion or lack of investor demand. A classic example would be Infosys IPO that was launched way back in June 1993, which was priced at 95 rupees, was actually undersubscribed. The straightaway opposite jargon is oversubscription. So an IPO is oversubscribed if the bids received from the investors are more than the number of shares on offer. Let's say the offering is said to be 1.5 times oversubscribed if there are 3 lakh bids for 2 lakh shares that are up for grabs. Paras Defense and Space Technologies Limited was a classical example, which was 304 times oversubscribed. Then we have underwriters, who are financial intermediaries who undertake to subscribe to the securities offered by the company if it is not fully subscribed by the public. So in the Infosys scenario, it was Morgan Stanley who bailed Infosys out by taking over 13% of the equity. And the final jargon is the green shoe option. Now the green shoe option enables the issuer of the company to release additional shares, which is typically around 15% in the event of an oversubscription. This is also called as over allotment option. But still there are three important dates to remember. The IPO open date, which is the date in which the investors can apply for the shares, and the IPO close date, which is the date at which the issue stops, and finally the listing date, which is when the stock begins to trade in the exchange for the first time. Now that we know what is what, it will be very easy to understand the entire IPO process. Now let's take a look at the entire IPO process in a step-by-step manner. The first step is to hire an underwriter or investment bank. The company can seek assistance of financial experts such as merchant bankers to begin the IPO process, and they will act as intermediaries between the company and the investors. Now, the underwriters, as we have learned, provides the firm with the assurances on funding. Now, there are specialists who will review the company's critical financial metrics, and they will sign an underwriting agreement, which is actually a contract between an underwriter and the firm applying for the IPO, where the underwriter guarantees the sale of the issued stock at the agreed upon price. The second step is the registration for an IPO. Now, the draft red herring prospectus is created as a part of this IPO process along with the registration statement. Now, according to the Companies Act, the submission of the DRHP report is mandatory for an IPO. I'll post a link of a demo DRHP document, and if you want, you can check it out. Now, here are some of the main elements of a DRHP document. Definitions, which includes explanations for the terminology used in a specific industry. For example, the terminology used in auto sector and IT sector can be different. The second are the risk factors. In this section, you will find potential issues that could affect the company's finances. The third element are the use of proceeds. In this section, it is made clear what will be done with the funds received from the investors. It can be for the expansion of business or repayment of debt or both, and you will find these details here. In the next section, you will find industry description, which describes the operations of the firm within the broader industry segment. For instance, if the organization is in the IT sector, this section will include the forecast and predictions regarding the IT segment. Then comes the business description, which will detail the core business activities of the company, followed by the management, which is a section which provides the information about the key management personnel. It is followed by the most important section, which is the financial description section, and it comprises of all the financial statements of the company like balance sheet, profit and loss statements, cash flow statements, along with the auditor's report. And the last section will include the legal and other informations. The DRHP document has to be submitted to Registrar of Companies 3 days before the offer opens to the public for bidding. Post submission of DRHP, the company can make an application for an IPO to SEBI. So the third step is verification by SEBI. The market regulator SEBI verifies the company's disclosure of facts. SEBI then makes the decision on whether to issue a go-ahead or no-go to the IPO. Now the business can announce a date for the IPO if the approval is granted by SEBI, which takes us to step 4, which is making an application to the stock exchange, where the company has to make an application to the stock exchange for floating its initial issue. Step 5 is creating buzz or hype by roadshows. Now the business aims to generate excitement in the market through roadshows, which are a series of sales pitches, meetings and events prior to an IPO. The company's executives and employees will spread the word about the upcoming IPO across the nation over a 2-week period. In a sense, this is a marketing and promotion strategy to draw in possible investors. And the key highlights of the company are shared with various people, including business analysts and fund managers. 6 is the pricing of the IPO. Now the business has to decide upon the pricing of its IPO, and it has 2 options for pricing. Either it can be a fixed price offering or a book building offering. Now in a fixed price offering, the company determines a fixed price at which its shares are offered to the investors, and the investors will be already aware of the share price before the company goes public. Now the downside is that the demand from the markets is only known once the issue is closed. But in case of a book building offer, the price range of 20% is declared upfront, after which the investors may submit bids that fall within this price range or price band, and the investors must then submit their bids in accordance with the minimum number of shares to be purchased or the company's specified lot size for the auction. Then the company further specifies an IPO's floor price, which is the lowest bid price, and an IPO cap price, which is the maximum bid price. Now this is how the price band is decided. Now the investors have the option to modify their bids within the allotted time during the booking period, which is normally 3 to 5 working days. And the company will decide the cutoff price, which is the final price at which the issue will be sold after the bidding procedure is complete. The next step is the allotment of shares. The allotment process is also very crucial to understand, because if you have ever applied for shares in an IPO, you have probably noticed that many times you weren't given any shares, but perhaps your close friend or relative may have received some of the shares in the same IPO application. So why does this happen, and how are IPO shares allocated to applicants? Now let's examine the causes of zero allotments and understand in detail the entire allotment process. The first come, first served is not the foundation of IPO allocation in India. The way investors respond to an IPO will have a major impact on the whole allotment procedure. Sometimes an investor may receive all the lots for which he has applied for if the IPO is undersubscribed. But if the IPO is oversubscribed, an automated procedure is used to distribute shares to the retail investors. And as you may know, after a company launches an IPO to the general public, all bids for the shares are registered online through brokers, and all the incorrect bids that were filed wrongly are removed from the total number of bids using an online procedure. And after this step, you know the precise number of winning bids for the IPO. Now, as mentioned, the allotment of IPO shares depends on how the investors have shown their interest in it, and there are two different cases that affect the IPO allotment process. Number one, the total number of successful bids is lower than or equal to the total number of shares that the company is offering, which is also known as undersubscription. And the second is when the total number of successful bids exceeds the number of shares that the company is offering, which is oversubscription. In case of undersubscription, the total number of bid lots by all the participants combined is less than the total number of lots being issued. So everyone will get an allocation of the same number of lots that they had bid for. So every applicant who has applied will be assigned shares. But in case of an oversubscription, where the total number of bid lots by the applicants is more than what is being offered, then SEBI rules are taken into consideration, according to which no individual can be allotted more than one lot. Let's understand this with an example. Assume there are 10 lakh shares offered to investors and the minimum lot size is 50. Then the maximum number of investors who will get at least one lot is 10 lakh divided by 50, which is equal to 20,000 people. So only 20,000 investors out of the entire 1 lakh investors will be allotted at least one lot of shares. For the allotment procedure for case 2, let's say if it was a small oversubscription, then all participants will receive the minimum lot, and any investors who has placed bids for more than one lot will receive a proportionate part of the remaining shares. But what if it's a large oversubscription? If that is the case, even one lot cannot be distributed to each participant, and the allocation is done by a lottery draw. Now, without showing any bias, a computer system will conduct this lottery draw, and as a result, during periods of significant oversubscription, not all names are picked in the random draw, and not all participants are given shares. So, if someone tells you that they did not receive any shares in an IPO, you know the reason, which are: number one, your bid was rejected because it contained wrong information, be it an invalid demat account number or an invalid PAN number or duplicate applications. The second reason may be there was a significant oversubscription for the IPO and his name was not chosen in the lucky draw. And the last and final step is listing of the stock in the exchange. Now, if you are a retail investor, there are a few things that you need to keep in mind the next time you file for an IPO. Number one and most common thing you need to understand is that you have to fill the details properly. Now, this is the most basic step. Do not rush while filling the IPO forms. Remember to verify your name, demat account number, the category you are applying for, and other details specified on the form. Even simple errors and wrong information can get your application rejected. Number two, avoid big applications. SEBI's allotment process treats all retail applications equally, and the only way to improve your chances of receiving an IPO allocation in case of an oversubscription is not by making a big application, but rather it is wise to apply for shares through numerous demat accounts, such as those of your parents, friends, or relatives. And applying through multiple accounts can definitely increase the chances of IPO allotment. The third thing you can keep in mind is that always bid at a cutoff price or higher price band. Let's assume an IPO has been announced at a price band of 1000 to 1040 per share. If you bid at the cutoff price, it shows you are comfortable buying at any price between 1000 and 1040. Hence, it's a good idea to go with the cutoff price when filing the IPO application form. In case if the price is lower, the excess amount will always be refunded. The fourth and most important thing is to approve the mandate request. Retail investors apply for IPO by filling a form provided by the brokers, and they assume that their task is complete. However, when applying for the IPO, you will receive a mandate request. This request needs to be accepted by you from the banking app or website. In the event the mandate is not accepted, the funds will not be locked in your account and you will not be considered for the IPO allotment. Another thing to remember is to avoid last minute subscription. So if you have already decided that you are going to apply for an IPO, then go for it on the very first day or the second day. That's because on the last day, there could be technical glitches if too many people rush to apply for it. Some investors wait for the last day to submit their application form, as it allows them to understand the initial response of investors towards the IPO. But if your aim is to increase the chances of IPO allotment in a particular IPO, you may want to refrain from waiting until the last day for filling the form. And one final thing that you can do is to buy a parent or holding company shares. So having at least a single share of the parent company in your demat account, you will be entitled to apply through the shareholder category. And additionally, you can also place a bid in both retail as well as shareholder categories, which will definitely increase the chances of allotment even more. Now, what you need to understand is that not all IPOs are worth investing. While some IPOs turn to be multi-baggers, others will kill your wealth. So you need to be really picky when investing your money. So how to select the best IPOs? Here are a few things that you can keep in mind. Always read the DRHP document, because it elaborates on how the company intends to use the money that will be raised from the public and the possible risks for the investor. This will give you a fair idea about the company and its operations. The most important thing that you need to look at is the utilization of proceeds. It is very important to check how the proceeds raised from the IPO will be used. So if the company's objective is only to repay the debt, then it might not be an attractive choice to consider. But if the company plans to raise funds to partly pay debt and expand the business or use it for general corporate purposes, then it shows that the fund will actually flow into the business, which is good for an investor. The fourth thing that you need to compulsorily look at is the promoter background and the management team. You should closely check who is running the company. It is important to take a look at the promoters and managers of the company who play a key role in all its operations and functions, because the company's management is responsible for driving it ahead, and we want them to be ethical and respected people. This is one of the most important points. The financial health and valuations of the company. Now, the financial performance of the company needs to be checked in the context of whether its revenues and profits are growing or falling over the past few years. Now, if the revenues and profits are increasing, it would be a good investment, but that is just a single metric. There are many other metrics to consider when reading the financial statements. So I will make videos on how to read financial statements from scratch in my upcoming fundamental analysis courses. And the final thing you need to check is the issue pricing. So you should not make an IPO investment just because the company is famous. The company's brand name is one ingredient that distinguishes the best IPO from others. So popular companies can price their shares higher than what they are worth, like in the case of Paytm IPO. So you have to estimate the fair price of a stock through something called as competitor analysis, and this can be done by using ratios like price to sales or price to earning ratios, which we will cover later in the fundamental analysis course. But in short, both these figures are given in the company's income statement, and if these ratios are higher than those of the competitors, the stock may be overpriced and you should avoid such IPOs. Now that is all you need to know about an IPO, and I believe this video is quite extensive and informative. So if you find this video useful,
السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.